Hello, this is Rob Rowan with CFA Society New York. Welcome to our podcast, Compound Insights. Today we're talking about emerging market debt. We will look at the impact of inflation, COVID, and the federal government changes as of today, March 3rd, 2022. We are talking with Jen Liang, CFA. She's Vice President and Portfolio Manager at AIG Investments. She co-manages more than $13 billion in emerging market debt. Her role also includes improving portfolio analytics and marketing. Prior to joining AIG, Jen was an investment manager at Fosun Group and an associate at AllianceBernstein. So Jen, thank you for being here.
Hi, Rob. Thank you for having me. Great to be here.
So we're at quite an inflection point for a lot of emerging market governments right now. And I guess one of the top line issues that people are really interested in hearing about is the impact of inflation now and down the road. So could you talk about that, and feel free to segment by sovereign if you like?
Sure. We're at an interesting point of time right now because inflation just really continues to surprise to the upside here. And that adds complication to the road of growth recovery for emerging markets post-COVID. There are a lot of challenges to stimulate the economy, to achieve that balance between managing inflation and stimulating the economy, I think across the board for all of the countries in emerging markets. So consider Turkey as an example. Headline inflation has surged to a 2-decade high of 49% year on year. And price increases are pretty broad-based, as per numbers provided by the Turkish Statistical Institute. That adds risks for the already beaten up lira, and that displays the severity of the issue we're facing here. In Latin America, we've also seen inflationary momentum from rising food prices and energy prices, and there's upside risks to the forecasts as well. So those in front of the line in terms of experiencing dramatic inflation are probably Colombia and Chile, which translates to more aggressive monetary policy responses in those countries. And Peru has seen some positive surprises, actually, in keeping inflation under control. But that could be transitory, just given the higher energy prices we're seeing. And the Brazilian central bank has remained hawkish, having some aggressive monetary policy reactions. And I think in Latin America, we will continue to see inflation risks to the upside. In response, we have seen really uneven policy tightening across emerging markets. I think the Fed in the US has a track record of being slower to remove stimulus, and the Fed's lack of action from last year has actually given emerging market central banks some space to adjust policy rates. We saw that in a lot of high yielders last year, and now the low yielders catching up. So across the different regions, Latin America policy rates have also risen the most, followed by EMEA and then Asia. And then there's the distinction, I think, when we talk about different sovereigns between exporters and the importers. This is another way to look at the impact of inflation to show its impact is felt really different. There are countries facing rising deficit as energy prices really push up the import bill. So they're seeing a more challenging impact from higher inflation across the board. And businesses are going to keep raising prices to preserve margins and boost their top lines in a higher cost environment. So as a result, we're seeing cost rises, commodity prices rising, and both corporates and sovereigns feeling that pressure. And this is driving inflation higher in that circle.
So this is very interesting because there have been a lot of policy movements, but there's also been a lot of profound change in federal governments in Latin America. So how do you analyze those changes in fiscal terms?
So in recent years, no doubt, we have seen a lot of profound changes in the federal governments in Latin America. We have seen a rise of populism, protectionism, nationalism across the world, really, and driven by a lot of social distrust and anger towards the political class and economic dislocations we've seen. And that's somewhat exacerbated by COVID-19 in the last couple of years. So this is especially intense for Latin America with the busy political calendar last year, as well as going into 2022. So all the way back from AMLO, from Mexico, and then Bolsonaro, to now we are seeing Castillo and Boric coming into power. Markets I think, first of all, do not like the uncertainty when facing these political changes. If we look at how market responded to this development of populist movements and leaders, the biggest volatility we usually see is when these candidates emerge as a strong possibility. And we see relief rallies actually after the results of the election, and especially after we hear some moderation of the tones of the new administrations. I think if we use that as the guiding post, there are tactical trading opportunities and positioning adjustments that we as investors can make around the elections. So sovereigns, quasis, and even the more liquid or crossover type of credits around emerging markets are the most susceptible to the initial sell off, while the strong credits always held in better historically through the volatility. With the Peruvian election last year, for example, sovereign spreads widened out. And then with the harsh rhetoric against the mining sectors, we saw movements there as well. And then fast forward, if we look at the market right now, all the change in the political landscape brought a lot more instability and headline risks. And it's always hard to quantify how much valuation should reflect that political changes. But I think that's a big driver for analysis, is identifying the type of noise we're hearing. In Peru, again, going back to that as an example, we just had the prime minister resignation, questions as to whether the president will be impeached, the cabinet reshuffle. There's a lot of noise, but the new administration's willingness and ability to carry out disruptive policies remain pretty constrained, and it's still a relatively stable economic story. So sovereign bond spreads tighten back up very quickly through that noise. So in conclusion, I think we haven't seen economic success really from these populist or leftist leaders. So we have yet to find a solution to drive economic recovery for Latin America, which is what ultimately, from a fundamental standpoint, would generate greater returns and set the countries apart.
True. That's a good point about noise and the difference between the analysis and how the market evaluates these things. So you mentioned COVID. How do you view the impact of the pace of the emerging markets recoveries from COVID?
Well, COVID is definitely one of the biggest questions nowadays. Overall, I think emerging market countries are hit very disproportionately by COVID. That's on top of the structural growth issues that already existed in a lot of the countries. The paths to recovery have also been uneven, just given the availability and execution of vaccination programs and different policies related to travel and reopening efforts. I think the base case, we're heading back to normal, to a living with COVID scenario. And vaccination in Asia is seeing a sharp pickup as well, which will allow many countries, I guess ex-China, to really reopen their economies and borders more permanently and reduce the risk of lockdowns from here. And the severity of the impact should also decrease as we come to this point in time. If we look at South Africa now, as an example, at the end of the fourth wave of their COVID infections, evidence has really pointed to the recent wave as having caused much less economic disruption than the previous three waves. However, I definitely see we have a long way to go. Especially there's the cohort of EM countries really reliant on tourism, and there's a lot of them. So we're seeing most countries trying to reopen and attract tourist income, with even Asian countries, but across the board, we're still very well below pre-pandemic levels.
So one of the major economic pressures from COVID was the impact on the supply chain. How are you all reading that?
So that's another big question we don't really have the answer to right now, right? The supply chain issue kind of in the post-COVID days. In the sovereign space around emerging markets, the impact of supply chain constraints has really varied based on each country's economic recovery, reopening, main exports, and their trading partners. And among the corporates, the supply chain issues have the greatest negative impact on certain sectors like the consumer retail, automotives, TMT, and food and beverage sectors for a variety of reasons, including raw material shortages, labor shortages, there's shipping bottlenecks, and definitely an inability to pass cost increases onto customers, which are impacting the margins of the corporates. The commodity space also face logistical issues that are pretty severe, but these are offset somewhat by the high commodity prices we're seeing right now. And everything here is really all connected. And one of the major reasons behind the weakness in Mexico's third quarter GDP was the negative impact of chip shortages for the auto industry. And EM corporate fundamentals have been better actually than pre-pandemic levels. So as we saw fourth quarter 21 earnings come in, and so far, most companies have reported solid earnings across sectors, especially in oil and gas and metals and mining, as we mentioned, the special dynamics in the commodity space, and given that strong commodity price, as we just discussed. And banks are also seeing loan expansions and higher margins despite higher provisions. So I think the impact of supply chain definitely still exists here and is a different story for sovereigns and for corporates in different sectors.
And it is a good point about the connections between all those things. That said, while there is connection, there is a center of gravity that I like to refer to as Brazil. So how do you read Brazil right now?
With Brazil, the biggest topic right now and where everyone have their eyes on must be the election that's coming up. Although it's only, although it's still 8 months away and a lot can still change, polls are indicating that former President Lula is favored to win, and market somehow seems actually to favor Lula over Bolsonaro. And if President Lula wins the election, I assume we're actually returning towards a welfare state with social programs and tax reforms that benefit the poor. The key here, I think, is the economic team. The administration should try to manage market expectations and really avoid doubts on debt sustainability and try to find that middle ground between the market and their political agenda. And in terms of the macro picture, I see risks to the downside. So Bolsonaro is unlikely to change his fiscal stance here before the election. And a weakening BRL also increases debt burden for the country in terms of its external debt. And economic growth remains challenging for 2022. And in Brazil, these days, looks like the equity market is in a short squeeze, and there's a lot of momentum. In the bond market, the entire complex have been selling off along with the rest of the market we've seen since the beginning of 2022. Although aggressive central bank tightening and Lula's comment that he might be more business friendly, that offered some relief for Brazil overall. But valuation now, in my view, is still expensive, especially on the sovereign side for a double B credit, considering these negative factors we just talked about. And we favor the corporates given the strong fundamentals and attractive valuation. And that's pretty much actually consistent to the overall EM view for the space. In terms of the domestic sectors, I am less positive on, especially those easily impacted by the change of the government. For example, like telecom sectors as opposed to exporters. And Petrobras is another one, really solid credit, a favorable stories throughout the last few years, but that's going to be a name that's susceptible to sovereign headlines and the market volatilities that come with it. But when it comes to metals and mining, pulp and paper, these have been sectors with pretty supportive supply and demand dynamics and leverage. And that mostly continues to be an improving trend. And Brazilian corporates is also one of the few spaces with some upward rating momentums, for example, in some petrochem names. I do think, though, a lot of names, both IG and double Bs, have repriced to reflect the positive development.
Great. Well, thank you, Jen. This is really fascinating. It's a very quick run through of a lot of emerging markets. Could you now please share the disclaimer with the members who are listening to our podcast?
So the material in this podcast is only for discussion purposes and should not be construed as investment advice. Investment strategies are speculative and involve significant risks, including loss of the entire investment. There can be no guarantee that investment objectives will be achieved or that the investments will be successful. Information provided is based on matters as they exist as of the date of preparation and not as of any future date and is subject to change. AIG does not make any representation or warranty, expressed or implied, as to the accuracy or completeness of the information.
Well, thank you, Jen. That was a very interesting look at the emerging and frontier markets. I'm very pleased to invite everyone to dial into our next podcast, which will be with Miriam Farboudi from MIT, on which we'll be talking about some serious fintech issues that might affect the market pretty soon. Until next time, I'm Rob Rowan, and thank you for downloading our podcast, Compound Insights.